I think two areas are really areas to watch out for. The first is the fraud. I think the fraud that's hiding in plain sight, which is the aggressive and over-aggressive use of metrics rather than GAAP earnings. And we see it particularly in the lavish use of share-based compensation in Silicon Valley, but everywhere, where people simply are paying employees with stock and adding it back to pro forma earnings. Any way you cut it, compensation is an expense. It should be expensed, whether paid in stock or cash. And then I could go on with all the adjustments to EBITDA in the private equity space, and we don't have time to get into all that. But a lot of the aggressive and maybe overly aggressive behavior is staring you in the face in this cycle, and a lot of it on the West Coast. And then if we want to go further west, I think the other area, and we saw it this morning with Luckin, you have to avoid these Chinese companies like the plague. I'm sorry. I mean, I know how many times investors have to be burned in these companies that are just too good to be true, growing at 40, 50% a year, with all kinds of odd transactions with affiliates, variable interest entities based in Cayman Islands.
Hey Jim, I want to just clarify some of that because I think it's an important point. MSCI, as part of their index management, specifically over foreign stocks and emerging market stocks, have given China a greatly upgraded role in the makeup of those indices to the point where investors buying overseas stocks increasingly own more China if they're hugging that benchmark. And let's face it, most are. So that's part one. Part two, the exchanges have somewhat blessed investing in Chinese companies by virtue of the fact that many of them are listed on either the NASDAQ or the New York Stock Exchange. So do you see those two things as being part of the risk here for most investors watching us right now?
Well, I think that those are certainly have contributed to investors either love affair or overweight in China, and as well as the idea that now listen, I've been known a little bit as a glass half empty guy in China, to be fair, but the secular growth rate that China reports is awfully attractive to people. If the economy is really growing 6% a year and the rest of the world is struggling, why wouldn't I be looking there for secular growth stories? The problem is that an awful lot of those secular growth stories are manufactured literally for Western investors, and that's the problem. And so we had been as light in China, if you remember, about a year ago when you guys were talking to me, we were as low to the ground in China as we've been in years. We've been increasing our Chinese exposure in our global short funds and global hedge funds because I also see another problem, which is coming out of this crisis. I think U.S. China relations are really, really have been harmed. And if we had seen some of the activities from China last year that we're seeing now, such as expelling all Western journalists, and really things like that, a year ago, I think people would have been running around with their hair on fire. But because it's happened in the backdrop of the virus, we've kind of neglected it. But things are getting much, much worse on the U.S. China front. And if you think about things about corporate supply chains post-virus and reliance on imported products that are essential to our well-being and national security, I think, and even if you look at the Democratic positions, the Biden positions, and others, I mean, they've hardened as well. And so I suspect that things are going to get worse between the U.S. and China before they get better.
So you're as negative today on China as you were many years ago when you were the loudest voice.
Well, we were one of the only voices. No, we're not as negative as we were in 2010-11. We had about a quarter of our global short funds and hedge funds short China, but we got down as low as 5 last year, and I think we're a little bit over 10 right now.